Okay, it's showtime, right? Hey, my name is Jay Norris. Thanks for attending the webinar. Always a pleasure to see you guys. I'm with IBUniversity, Director of Learning, etc. Before we go any further, we definitely have to remind you trading futures and forex is a risky endeavor and not suitable for all investors. Hi, Alan. Good to see you, my friend. We mean that definitely. As I always say before we start anything when we're teaching, particularly when we're in live markets, we need to remind you that if you have bad habits in life, they tend to be magnified in trading. Anything that involves emotion and money, look out. That's the potential for trouble. You really have to be humble. You know, I'm realizing that lately when I'm trading, it's work. You know, it is work. I mean, it's exciting, it's fun too, but especially if there's other things going on. You know, if the weather's nice and yeah, you know, honestly, if it's good to love your job overall, but at any rate, you guys know what I'm saying, right? Don't take it too seriously. Trading definitely can be a mesmerizing business, and anything that's mesmerizing, you need to be aware of that. Hi, Boyke, good to see you, sir. I think all you guys understand the disclaimer. I'm a 20-year trading floor veteran of the Chicago Board of Trade. You know, people talk about the good old days. I'm telling you, to me, I think everyone has it better now. Certainly, the transaction costs are a whole lot lower. You're able to see so many things at once. So, yeah, it was interesting that was an interesting experience for me. It gave me a lot of insight, certainly a lot of experience. But it doesn't make me any better than any of you guys now that we're all on the screen, right? I've written a couple of books on trading, Mastering the Currency Market by McGraw-Hill, and Mastering Trade Selection and Management. The tactic we're going to show you today, one of the tactics we're going to show you today is highlighted in the book on the right, Mastering Trade Selection and Management. What makes these books unique from my perspective is that they both include trading plans which allow you to backtest the information provided. That's about as transparent as it can get. We spell out a trading plan so you can go into any market on any time frame and backtest what we're showing you. So these are two books. And again, to me, they're unique because they do provide trading plans and they give you step-by-step instructions. So again, transparency is so important for all of us. And of course, I'm a professor at IBUniversity. I'm a founder of Trading University here in Chicago. We provide educational material, etc., where I spend a considerable amount of time teaching and demonstrating the art of discretionary trading in live markets. It gives me a huge edge as a trader, as an educator. The method we teach are both mechanical and behavioral, in that we're going to give you a mechanical framework to measure not only price pattern, which is critical, but also direction, which we're going to cover today. It's absolutely critical you understand how the price pattern is aligned, and obviously the key is knowing when direction is aligned with the price pattern. You know, last week we switched around things a little bit, and I wanted to touch on trading philosophy, i.e., your belief system. My belief system is critical. I realized it not that long ago that my philosophy gives me a huge edge over a lot of traders. Whether you know it or not, your belief system is either going to help you or hinder you. Most of you, it's going to hinder you because just that's the way you're wired. We're really not wired to go in there and take other people's money. We're not wired to just sit in front of a screen for hours and hours and wait for that setup and jump in there and get in there and then ride that market, let that market pay us. It's really not work. You're sitting there looking at a screen. You could argue it's not even work. So most of us are wired wrong to trade. Your belief system is critical for you, whether you know it or not. Unlike the banks, that's right. You know, nothing surprises me. Trying trader, he's referring to the Barclays deal. I'm telling you, they're not nice people that run these firms. Believe me. And they don't do what we do. We're discretionary traders. To me, you know, this is the last bastion. You're not going to bluff or cajole a market. You're not going to steal from the market. No. You have to be very, very good. You better know what you're doing. Those guys would never make it as traders because number one, you know, they wouldn't. I mean, they're not going to. Anyway, I don't want to get off track, but yeah, they're not very nice people, and they're going to get what they have coming too. Luckily, hopefully. So trading philosophy, our belief system is critical for us. I'm going to touch on a couple of points here that you need to understand, and we're not talking about the right or wrong of these. We're just talking about the fact that they are powerful Keynesian influence at work in the market. Don't be concerned with the right or wrong of what the government's trying to do. Understand that they're doing it, and it's your job is not to anticipate what they're going to do next. Your job is to go along with what the market's doing right now. Very powerful Keynesian influence at work. I wrote an article over the weekend, and it was titled Stock Market Poised for Multi-Year Rally. That's all I'm saying. The market's poised for a multi-year rally. Now, if you look at a chart of the stock market, we'll get to that in a little bit, you can see that the market's already had a multi-year rally, right? So, in essence, all I'm doing is writing an article that the market's going to continue to do what it's already been doing all along. And, boy, you would have thought, if you go ahead and Google that article, it's on Seeking Alpha, Stocks Poised for Multi-Year Rally, you would have thought that I was coming out there and saying that advocating killing white babies or something, the way that the public was arguing that point, that they were saying, you know, you can't say that the market's going higher. And I didn't quite understand it myself. All I'm pointing out is what's going on currently. But my point here is you have to understand that there's a very powerful Keynesian work influence in the market, and it's not for us to, you know, it's the old saying goes, it's not to judge the right or not to judge the right or wrong. I forgot the saying, but to do or die was the tail end of it. But that is the point. It's not for us to gauge the right or wrong of it. It's for us to go along with where the market wants to take us. You have to understand that there's a powerful Keynesian influence. And we're going to show you a great example of this, exactly what I mean. So many times the headlines don't match what the market's doing, and people seem to have a hard time understanding that. To me, I view it from a completely different advantage point because of my philosophy. Price pattern is a reflection of all fundamental developments. That probably should be on top. That should probably be the first thing that you need to know. Price pattern is absolutely a reflection of all fundamental development. I don't care what it is, be it naturally, be it societal change, be it economic, certainly. It's reflected. It's in the cards. It's reflected in the pattern. So I don't have to argue with news stories. I don't have to read every story. I see the headline. I see the first couple of sentences, and I see the last couple of sentences. That's how I read. I'm a speed reader. Headline, first couple of sentences, last couple of sentences. Move on. You know, the best part, though, about price patterns is a reflection of all fundamental developments. I really don't even have to read all that stuff, although it does help. It definitely helps on an intuitive level, especially for an experienced trader. One of my first mentors, Bill Williams, one of my first off-the-screen mentors, Bill Williams, suggests that when you're first learning to trade using his method, don't read the news. That's good advice because you need to learn the method cold. Most people, they're going to take a method, they're going to take tactics, and they're going to apply it to what they're already going to do. And inevitably, what they're already going to do is going to take precedence over the new method. It's either all or nothing. Now, I'm not saying ignore the news. When you get to that experienced level, it's definitely going to help your intuition. But know that price pattern is already reflecting all those fundamental developments. Price pattern is key. Focus on the price pattern. Understand that the Keynesian backdrop to it. Don't be surprised by it. Don't argue with it. I saw a great quote this weekend. It said, it said we're not we're trading price, not the moral high ground. People get funny about their beliefs, like they they're all worried about debt and all this and their grandkids' debt, and well, that's all good and fine, but what's the best way to calm your fears? How do we get peace of mind? Make money as a trader, right? So you're not trading the moral high ground, you're trading price, right? And understand price pattern is a reflection of all fundamentals. I need to switch platforms now. Before I do though, a word on trading methodology. I'm big on methodology. You have to have a robust trading method which works in all environments. We'll come back to that. We're going to come back to the tactic I'm going to show you, but I want to stay on point as far as price pattern reflecting everything and give you some pretty good examples. Let me just switch slides here. Okay, can everyone see the new screen? This is U.S. economic data in August of 2010. Home sales down 2.6%. That's terrible. Factory orders down 1.2%. Hey, factory orders came in today a little bit higher than expected. Okay, thank you, Mauricio. You're seeing that screen, U.S. economic data in August 2010. Non-farm payroll minus 131,000. That's bad. Hey, by the way, we got a non-farm payroll coming out tomorrow. Durable goods orders 3.8%. That's horrific. This is in August. The numbers that came out in August 2010. So these are a reflection of the July numbers. Weekly unemployment claims 500,000. We're not all that much below that either. And Philadelphia Fed down 7.7%. These were terrible economic data. Just horrible numbers coming out. Now, here's my point. Price patterns already has all that worked in. Now, let's go to the chart of what was happening in August 2010. This is 2010. This is August of 2010 right here. This is August 30th is the date on that big red candle. No, I'm sorry. Here's August. So this is August of 2010. Look at how the market's set up, and these are our pattern lines on there. Let me mark it. There it is. That's the week of August 30th. See, August 30th right there. That's that week. Can you believe all that bad data, but what did the market do? That was the best time to be able to go in there and buy the market, wasn't it? So you had nothing but a bad data in that time of the year, and what happened? Now, this slide it highlights event risk. This is out of our graduate course, and one of the prime reasons people have event risk is because they don't know what the future holds, nor do they understand the leader-follower relationship between price and economic data. Let's go back to those terrible numbers we saw from August 2010. Keep in mind now, these were from August 2010, but this is July's data, right? So all this data happened to be July. It's actually July's data in August. So you have to understand that the leader-follower relationship, price leads. Price is going to lead economic outcome. Price is going to lead everything for the most part. It's very rare that something new, that's a game changer, comes into the market that the market hasn't discounted or worked in. I'm not saying it can't happen, but for the most part, you have to understand that it's rare and that price does lead the data. Now, we just showed you a litany of bad economic data, and that's how price reacted to it at the time. Now, there's no doubt about it that you had some bad news here in the market because it was down very hard, right? I mean, that was all cooked in, right? It was cooked into the books. You had some bad data there, but the price held pretty good. In fact, it held our zone here. We call that purple line happens to be a 50% retracement line, and look at where the market bottomed on there. By the way, you guys, this happens to be a change of direction candle right there. You guys should know what that is, and we're going to get to that and show it to you. So that happened to be our definition of a change of direction. That was weekly changed direction on the in August in August September of 2010, and didn't that prove to be a nice buy signal? But do you think there was a lot of people that participated in this rally? A lot of the public, even a lot of professionals? I don't think so. You know why? Because they were still hung up on all that bad data. They were still hung up on negative durable goods, terrible Philly Fed number, and they just couldn't kick it into gear when the time came when the market broke out here. They didn't participate till probably here. They waited for this high here. You don't want to wait for that high. Once that trend line goes, brother, that's that, you know. You got to get in here. By the time you can get in here, yeah, you'll get a piece of that. That's a good payday right there. This would have been a bigger payday, though, right? So let's not forget about all that bad data too. Before you're licking your chops, looking at that big rally, and well, it was a big rally, wasn't it? Let's go back to all the bad data. So you just can't get away from the fact that price is going to lead. How you're going to be better prepared to handle that is certainly have the experience to see it. But if you go back, let me go back a couple of slides. Oops, I went too far. Here's what I want to make the point. Oh, I'm sorry, I'm on the, here, let me switch up. But here's my point. If you're going to get past this, let me get back to my other slideshow here. Price pattern is a reflection of all fundamental developments. Hopefully I got back on time. You guys can see that. So it's essential. And I'm probably boring you, belaboring that point, but believe me, it's a significant point as a trader that you have to understand that price pattern is a reflection of fundamental developments. Back to method. We all know this. You have to have a robust trading method which works in all environments. Hey, it took us 4 years to put together a trading course that teaches an objective empirical method that you can literally use in all trading environments, meaning up markets, down markets, sideways, regardless of the fundamentals, regardless of day-to-day news flows. And what's this going to give you as a trader? It's going to give you peace of mind. Believe me, these guys that one of you guys mentioned, the big banks in the news now, those guys, they'll never have peace of mind because they're just not doing it the right way. Eventually, they know they're going to get caught, and now they're pariahs, and that's that. But if you have a sound methodology and you know how to go in there and do what you need to do, in the long run, you're going to have that all-important peace of mind, and that's what every trader, that's what we all strive for. This is a very simple point. If you're going to have a method, it's got to be simple. It needs to be simplified for you. It needs to be easily explained. I'm not going to go into this. I'm not going to belabor these points. I'm just going to hit on them real quick. We use price pattern to identify a market's growth pattern. Very important. We use the scales of those growth patterns on the lower time frames to identify buy and sell zones in line with the higher time frame patterns. In other words, we use retracements to help gauge the strength of the market. And this is what we're going to show you today. We provide a fact-based trigger to enter and exit trades, show you how news and momentum filter your trade selection, and that's what we're looking at. I'll give you we'll give you some quick examples of this too. So how can we help to improve your trade selection? That's always the question that you should be asking of anyone that's teaching you something. What's in it for you, right? How can this help you? Very important, very legitimate question. You need to know when direction is aligned with price pattern. Pretty simple stuff. Here's the price pattern of the euro. Just mark off the highs, mark off the lows, have enough data on the chart, and then you can make that out that, yeah, that's you're in a downtrend. So if you want to make money from that, you have to understand that you got to take modest positions. People get in trouble because they put on too much size. It's never the market movement that kills you. It's always the size. People are greedy, so you have to have modest positions on. You have to be in a position to sell rallies in downtrends and buy dips and uptrends. Where's euro now? Well, it happened to be back up towards 127 or so, but it actually got all the way to 123 here. And, here's just another simple example of price pattern where you can see what's going to happen on these lower time frame here on the right of the chart. See that little pattern, 3 legs up? Notice how that little pattern is going to be a reflection in the long-term pattern overall, and that's a phenomenon we know as scalability, fractal geometry. It's very, very important for you to realize that markets are scalable. That the growth patterns, essentially, what you're seeing, are scalable. I look at a market as a plant. If you look at the plant, if the plant's getting sun and water, it's going to grow. If it's not, the plant's going to wilt. It's pretty obvious when the plant's growing or not. So if you're patient, you can see day to day the development of a plant, right? But if you're going out there digging up the seed every hour and looking at it like so many of us do when we're first learning to trade, we're not gonna get in tune with that pattern. We're not gonna learn patience. Anyone who's had a garden understands patience, and you'll check on that garden twice a day. You're okay. Give it a little bit of water. As long as it's getting a little bit of sun, the garden's going to be fine. Do not dig up the seeds, right? So you got to be patient. Easy enough to see that you have a growth pattern, and then once you understand to identify the growth pattern, here's where you want to focus. Those times where direction changes in line with the pattern. You got to see the pattern. You got to know when direction changes in line with the pattern. Right? Here, you guys are probably getting bored now. Let me go to a live chart and show you examples of this in today's markets. Okay, as you're seeing that's your Australian dollar. So I'll scrunch that chart up. Okay, cool. You guys could probably see the pattern, right? You can see the pattern with the naked eye. You have, heck, even if we'll leave that big rally there. But here would be the pattern. Right? There's your pattern. Not that difficult to discern that, right? Because you have a pattern of higher highs. Here's a higher high. Yep, just barely made a higher high. Here's another higher high. Here's higher lows, right? This is very important to us, higher lows. So what we're talking about is know when direction changed in line with the pattern. So right there, I could say there's the spot. There's the spot. There's the spot. There's the spot. So you need to know once you identify the pattern, then it's just a matter of identifying when direction changes, when direction shifts in line with that pattern. Pretty simple stuff. This is a 15-minute chart of the euro US dollar. I'm sorry, the Australian, my boy, the Aussie here. Look at that nice little hammer right on my green line there, right on my support line. That happens to be a pivot, so that's a good time to be in the market to understand that that's happening. And regardless of the market you show me, I can show you that it's pretty simple stuff to identify that pattern. Here you happen to have here. Let me see if I can bring this chart out. Hopefully you guys can still see this chart here. This is the euro US dollar. Let me just refresh the camera just in case. This is the euro US dollar, right? Now here it happens to have a bearish pattern. No surprise, because guess what? The euro's in a bear market, right? Here you have a lower high, right? So here in the euro, you're looking for these times here. Well, it didn't work out so well, but you would have been stopped out there, so you had a small loss. That happens too. Here you're looking for, there you go, there's a sell signal, and here's another sell signal, and maybe you get stopped out there. And you're mindful that this is a buy signal, but it's a counter trend buy signal, so it looks like you're potentially getting a sell signal right now. So it's gonna be that simple. Oh, here, let me reset the screen. There you go. Can you guys see it now? I was just pointing out this is the euro, and I was pointing out this is a 15-minute euro chart. Here's where you're at now. So you have a pattern of low or high. So all you're doing is looking when that direction changes in line with that bearish pattern. Now, last week we talked about negative and positive interference, and that's a very important aspect when your markets would happen to have low non-systemic risk, such as the stock market, such as the Aussie. When they're going up, that's going to create negative interference for a bear market like this. So that's why you're really not getting a whole lot of follow through here, and that's why you had a little bit of a rally here, because your alpha markets and alpha markets are always going to be those markets that have low non-systemic risk. They're going to be that's going to work out. GY for long-term chart. Yeah, here let's go see what you're talking about. Long-term. Well, I got so many lines on there, don't I? Here, let me clean out the lines here. Okay, here's my long-term Australian dollar chart. And GY was pointing out he wants to see what's going on the long term. So this would be, well, here I'll keep it simple. That's pretty long term. That's what I call a grand pattern. Here would be your primary pattern, and your primary pattern in our book is 10 months to several years, right? Here's the primary pattern. So here is a 50% of the primary pattern, and anytime you see a purple line on my chart, it's going to be a 50% retracement. Oh, I'm sorry, guys. Here, let me. Okay, hopefully you guys are looking at the Aussie now. This is a weekly chart. So we're looking at, so we could see the grand pattern, which would be 3 to 5 years is up. Okay, cool. Now this is, we're going to the 2010 low. This would be my primary pattern, because the primary pattern is going to be 10 months to 3 years, or 10 months to a couple of years, a few years. So I drew my 50% retracement of my primary pattern. Here, I'll show you where that came from. So I can see with the naked eye, my primary pattern is still up because it's giving me, it hasn't retraced. Oops, it hasn't retraced beyond my zone. So as long as it's above that zone, my primary is up. So my primary pattern is up, and I mark my 50% because I know that's a critical line, that 50%, right? Now I think what GY you may have been referring to as the long-term trend is the secondary trend. Now let's go to a daily chart, and we can see that the secondary trend is down. Right? And now we talked about this last time we were together. It broke that secondary trend line. So when you get a couple closes above that secondary trend line, you have to be in a position where, hey, look out, we could be in for a secondary trend shift in line with the primary trend. So that's a secondary trend line break there. Also, we got a big heads up when, you could take these trends, and oftentimes you'll have a short-term secondary. This would be your long-term secondary going all the way back to March, and this would be your short-term secondary, or, your day-to-day, basically. So when we see that last impulse move here retraced by more than half, then, we kind of go on. When we see that this guy, we see this last impulse move down retraced by more than half here. You got a couple closes above it. We have to understand, it retraced that last impulse move by more than 50%. It's breaking that secondary trend line. The market's in line with the primary pattern here. So what's happening? You're having a potential secondary trend shift. Well, you're having a secondary trend shift in line with the primary pattern. So that's what long term, that's what you look for, a change of direction in line with the pattern. So that's what you're seeing now in the Aussie, and that's pretty significant for us. So your secondary is still arguably I would call it neutral, but arguably it's down. Well, there you go. Look at that. Now you had a couple closes above that 50% on a daily basis as of yesterday, and we were aware of that too. So that's why we were focused on it when I showed you that 15-minute chart where it had those beautiful buy signals. It's real easy for me to be aggressive on a 15-minute chart when I see that my daily closed above that critical 50% line. So the pattern is shifting. The secondary pattern shifting in line with the primary pattern. Now, to me, the day-to-day pattern is extremely important, and I know we've all talked about that before. You look at you take a 4-hour chart, and go back and you look at a couple of weeks of data on a 4-hour chart. That day-to-day pattern should pop out at you. So let's just use that rule of thumb. Go back 2 weeks. So we go back to mid-June. You go back to mid-June, you can see you have a higher high and you have a higher low. So you have a pattern of higher lows, higher highs. So that day-to-day pattern is up. Why is the day-to-day pattern so important for us? Because the day-to-day pattern is a reflection of day-to-day news events. So I don't even have to have been looking at the news to know that we must have bullish news in this market. And that bullish news was the U.S. housing numbers, and the Europeans coming to a solution, and a strong U.S. stock market too. So that's been the good news in this market. So my day-to-day pattern's up. My primary pattern was up. My day-to-day is up. Secondary in the process is shifting, and certainly my micro is up. So when you get me down on a 15-minute chart, which is a micro chart, I'm picking these up all day. I'm picking up these retracements all day long. Here was the one from today I was focused on right there. See how it got right into my zone, and I'm looking for that. I'm even more bullish now that my alpha market, the S&Ps, are in a position to eclipse long-term resistance too. Hopefully you can still see this chart. This is the stock market. This is the S&P 500, and we call this the alpha market. Hopefully everyone can see the S&P 500 chart here. You're in a position to eclipse that key level right there. You took out that high, so you took out the trend line. So these are all telling me that you're going to have good news on the horizon. So keep in mind what we showed you before about the terrible data in August of 2010, and then what happened. The market rallied like the devil out of there. Keep in mind, generally economic data is a month delayed or a quarter delayed. So this chart is telling me that if you can close above that level, now it got to that level, that's not to say we can't have a correction, but just by the fact that it got to that level, that's pretty tough. If it eclipses that level, you're going to shift. Well, yeah, if it eclipses that level, you're going to shift the secondary pattern higher. And guess what? Your primary is already higher. Your day-to-day is higher. Your micro is certainly higher. So if you shift this secondary pattern in the stock market higher, that's going to be a big deal. And this is your alpha market too. So you're going to take everyone along for the ride too. There, meaning these other markets too. But hey, nothing's predetermined either. Keep that in mind. Nothing is predetermined in trading. That's for sure. But let me get back to the show and show you. Whoops, let me get this out of the way. And get back on point, and so I could show you that one tactic that we're going to show you. Oh, thanks, guys. Well, we'll see. Michael's saying great article on Seeking Alpha. We'll see if that's correct, though. I mean, nothing's etched in stone, that's for sure. But really, we're just looking for a continuation of that trend. Let me get back to the slideshow here. So price pattern, all important. We know what we're really looking for here, and that's an example of fractal geometry scalability. We know we're looking for those times when price pattern shifts, when direction changes in line with the price pattern. And there's just another example of scalability. and scalability is everywhere in the markets. It doesn't matter. The short-term charts will emulate the higher time frame charts. The higher time frame charts will emulate the short-term charts. It's a two-way feedback mechanism, markets, and it amazes me day in, day out. I'm no longer as amazed, but it's still something to see every day how the markets just replicate those patterns, and it's geometrically nearly perfect so many times. Oh, absolutely, GY, absolutely. He's saying it is. It's the size and the greed that will kill you, because markets will always correct. In fact, that's a part of my philosophy too. I'm not big on breakouts. There is a time to take the breakout, but to me, I'm always going to wait for a dip, because markets are always going to dip. Markets dip in uptrends, they rally in downtrends. So just be patient and let the market come to you. Yeah, Kimbo, right on. We take what markets give us. Yeah, you're not here to predict what's going to happen. You just go along with what's happening. The denturist. I don't even know what that would mean. Lagarto. So scalability, very much a part of how markets move, and repetition too. You're always going to see repetition, and boom, boom, boom. You expect it. Expect repetition, and then you're going to focus on those times when you're going to focus on those times when direction changes in line with the pattern. And this pattern, by the way, this is the Australian dollar. This same pattern played out the following 2 months in a row. I mean, you could have just been hitting every sell signal on the way down there. Oops, sorry about that. Okay, we're back on the screen there. So we're always focused on when direction shifts in line with the pattern. And here's another example of that. This happens to be the euro, and you can see this is the overall pattern. You can see the pattern of higher lows and lower highs and lower lows. And always mark those isolated levels on the chart, because it reminds you. It's so simple, but it's amazing how you can look past it, especially when you start putting overlays on the chart and you start reading all kinds of articles about this and that. Keep it simple. And this is just a micro of the macro. See the big pattern, the macro bearish pattern, and it's just a micro of it. You can see here's right in here. Look at that. Lower highs, lower highs, lower highs. So you want to be there when direction changes in line with the pattern, which is what happened here too, and what price dropped all the way down to 123 after that. So always be aware when direction changes with the pattern. Now we're going to show you specifically what we define as a change of direction, because if I'm saying no when direction changes in line with the pattern, we need to define direction for you. And I think we've done a good job of defining the pattern. I think you guys all understand that naturally. You do, by the way. If you guys didn't understand this, now take stock in it, that the one thing that we humans are way better at than computers happens to be pattern recognition. A simple pattern for the computer it's tough to see. The computer needs exact images. The computer needs things in a linear order. Markets certainly are not linear. They certainly are not exact. But you could see the same pattern. That you can have the same geometrics to a pattern, but it can look a lot different pattern to pattern. But we as humans will pick up the similarity in that. The computer doesn't stand a chance. So don't let the computer get in your way. But let's define change of direction. A change of direction is a trend line break, which we all know what that is, plus a directional line shift. So we need to very quickly define directional line shift. Directional line defined, it's the low of the highest closing candle in an uptrend and the high of the lowest closing candle in a downtrend. How to hide the mask and how to identify the price pattern direction change. That it's a geometric measurement for us. It's a proprietary technique that we teach in the courses, and I apologize, we're a little behind in upgrading our online campus. But yeah, it's just simply you look back and you measure the pattern, and it's essentially the retracement of it. If it retraces X amount, then a little bit more complicated than that, but that's basically it. It's pretty simple. Yeah, the trend line is your first indicator. A trend line break will not reverse a pattern, but it'll come close to it. So you better know when the trend line breaks. I prefer to already be in a short position as patterns reversing, because what happens is a pattern will reverse, but inevitably it's going to go right back in. And let's say like the Aussie dollar, where the secondary pattern is reversing from bearish to bullish, you're going to get a correction in there. And that correction is going to be a doozy, because it's going to be a lot of people thinking it's another leg down, but it's a correction of the new up move. So I'd rather let the pattern correct than give me a sell-off to buy or a rally to sell. I'm big on buying dips and uptrends and selling rallies and downtrends. I'm pretty good at identifying those trends ahead of everyone else, because they think it's another leg down in an uptrend. I understand from my perspective, it happens to be, I'm guessing it happens to be a new leg up and a new uptrend, because I'm always banking on that long-term pattern. I'm surprised the stories you read on FX, the charts people show, they never have enough data on the chart. They're always showing you like 3 months of data, and they're surmising and making decisions on that. Okay, directional line defined the low of the highest closing candle in uptrend, the high of the lowest candle in downtrend. I feel good about giving you guys this, because it's not something that's going to be a rope that you put around your neck. You need to know what you're doing trading. If I give you something, hopefully it's something that's going to keep you out of trouble. Very simple. The directional line, if price is closing below the directional line, direction is down. Price is closing above the directional line, direction is up. And I'll give you an example of that. Here's a directional line change of direction equals a reversal. Remember I said price reversal equals trend line shift plus daily directional line shift. There it is. This is a trend line, right? This is the highest closing candle, not the highest candle, the highest closing candle. Once you eclipse the low of the highest closing candle and you eclipse the trend line, then you have a reversal. Same story here. Well, you can see it there. That's the actual reversal. Same story down below. It's not the lowest candle, it's the lowest closing candle. Once you eclipse the high of the lowest closing candle and you take out that trend line, then you have a reversal. So you got to know this. People say, oh, well, by the time it happens on a weekly, the move's over. No, that's not true. You know how I use it? I wait for the change of direction on the weekly, then I buy a dip on the daily. So you always want to trade. You always want to know what's going on in those higher time frames. I'm going to tell you something for nothing. Most people make the mistake of trading these lower time frames, of taking direction on the lower time frames. They got one eye glued on the news wire, and they got another eye glued on a 1 minute chart. Of course they're going to get chopped up. You've got to trade in line with these higher time frame patterns. And it's a beautiful, beautiful thing when you have three patterns come together and you see the moves that you get out of there. Hardest part about trading is being where you're supposed to be and when you're supposed to be there, and then acting on it, of course, too. You need to understand the risk, but focus on the reward. Yeah, a bearish engulfing candle. Yeah, that would be what we call that, Len. We call that a change of direction candle. But it doesn't have to engulf the low of the candle. I don't care about that. It just needs to close above that low of the highest closing candle. It needs to close above the high of the lowest closing candle in a downtrend, or close below the low of the highest closing candle in an uptrend. So know how that change of direction works. That's critical. If you want to know more about it, my book, Mastering Trade Selection and Management, chapter 3 of that book. And I tell you this, we always have to remind you this, before you risk your hard-earned money in the marketplace, please understand you need education and you need experience. And you need to have the time, take the time to put them all together. Inevitably, I know this firsthand, the trader with the education, and more important, the experience, is going to be the guy that ends up the money flowing into his account. Everyone else, the money just bleeds out of everyone else's account. So you got to stay with those demo accounts until you're confident, for sure. Let me, if I've got a second here, let me give you examples of the change of direction. and how that works and how simple it is, we'll just stick with this chart. We'll just stay with this Australian dollar chart that's on the screen right now. And you can see the pattern to it with the naked eye. How you have an uptrend, right? Now I'm going to put a directional line on there. This is a 15-minute chart, by the way. That's my daily directional line. That's my 4. That's a big tip-off coming in. I see the price above my daily directional line, which is the yellow line, and above the 240. So that tips me off right away. But let me drill down all the way to a 15-minute. Let me turn on my 15-minute directional line. Turn off these other ones. And guess what? You have to be above that weekly, too. So that's a market where the weekly, it's above its weekly, daily, and 4-hour directional lines. What direction do you think you want to play that market in, right? Long, right? So really, your Australian dollar, the only way to play it for us the last couple of days would have been long. Now, I'm going to show you how this line works. Okay, at this point, direction is down because price is below the, boy, I trade on a 15 and a 3-minute. I like the 3-minute, but the price is below the 15-minute directional line, right? So the direction is down. I'm in an uptrend, but direction is down. See how direction is down? What happened right there? Direction shifted now. It happened. It just happened to be right on a trend line, so they made it easy for me today, right? And this is today's Australian dollar chart. So direction was down. Let me back it up. See, price is below my directional line. Direction is down. Bam, what happens right there? A bell goes off in my head because I see that and go, oh, direction just changed up. Direction changed higher in line with the bullish pattern. I'm looking to buy dips. I'm looking to get in now small or buy dips and be patient. See how the line's going to keep me in that trade now. As long as that line is moving up, then direction is up. Stay long. What happened right there? Direction shifted down. What time of day is that? 11 o'clock. Lunchtime in noon East Coast. Right when we went on? No kidding. Lunchtime, right? So direction shifts back to down. So there's nothing for us to do now. And that's where we're at right now. So that directional line, pretty good stuff. So if you want to know more about this, I would say go to Mastering Trade Selection and Management, Chapter 3. That's good stuff in there. And again, what's unique about that book is it reads like a trading plan. Literally, from the beginning to end, it covers market psychology. It covers how to do a market overview, and that's how you determine. GY, thank you for asking, sir. Or ma'am, I apologize. I don't always know who. I just see your acronyms there. I've gotten in trouble for that before, calling people sir or ma'am when they're not. But thank you for asking. It's on Amazon. Amazon.com. Just Google Mastering Trade Selection Management. It's on Amazon, or it's on all the other Borders or whoever. So it's a good book. I mean, it starts out like a trading plan. It's the market overview. We use the market overview to determine how to make determine how to select the market to trade and direction to trade from. Then we give you the trigger, and then we teach you trade management and all that good stuff. Al G is my co-author. Boyke, he was an early mentor of mine. Market timer, there's a directional line for every time frame. There's only one though. It shifts back and forth. I don't use them so much because I can kind of see them with the naked eye. I'm more Al is big on direction. I'm more a pattern guy, but you need them both. So don't get enamored with direction and know it, but you got to work that in with everything else. I don't trade most of them, GY. I focus on the majors, and that's just because I can only handle so much. Don't let me distract you from, if you have a feel for a market and you're trading that market, that's fine. I can only really follow 3 markets at once and probably only trade 2 at once. I mean, if you're good, just 1 is enough, right? I wouldn't distract you from trading any of them if you have a feel for them. I happen to like the Aussie because it's a market with low non-systemic risk because it's got that AAA. Australia is still a good market so far. The biggest client is China, and when you have a slowdown in China, that just means 7% GDP, right? I trade the Australian dollar, the euro. I also trade the E-mini S&P. I like U.S. stock indices. Yeah, I'm bulled up on those right now. But hey, this is a fact-based method. I may write an article that I think the stock market's going to go up or just continue what it's doing. Yet on the other hand, if I see if the micro shifts, if the secondary holds and the micro shifts in line with the secondary, which shifts to day, then I'm back on the short side. GY, I really don't trade JPY. My best trade this year was long JPY back in January, February, but I haven't traded it since. I see it as having, I don't like markets that have both high non-systemic risk and high systemic risk, and I see the yen as that right now. There's just too many question marks. It's a laggard right now. William, I trade New Zealand. I haven't in a while, but it's the same as Aussie as far as I'm concerned. It's a great market. I mean, as long as they have, as long as there's a yield down there. I like Aussie, a little bit higher yield there. But hey, I've taken up enough time here. I don't want to go into the next guy though. Yeah, good point, Len. Yen's got a small average range there, so to me that euro still has a great range. Euro has a bigger range than Aussie. Hey, thank you very much, William. Yeah, I don't want to cut into anyone else's time, and I think we went a little bit over time anyway. Oh, Boykey's calling me out. You guys, thank you very much. Boykey, Market Timer, I like to have, I know where all the time frames are. I like to trade in line with the majority of patterns. And that's how I do it. But I like to I have a 15 and 3 minute in front of me at all times, but I know where everything else is. Thank you so much, Mauricio, and we'll see all you guys next week. Thank you very much.